Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, July 9th, 2024. It is 12:43 p.m. Eastern Time. I'm back at my desk. I posted an update under the first and only post I made up to this point earlier today, this morning, that I'd be away from my desk for a little bit. I'm in between errands, so I've got just a short period here back at my desk, then I've got to run out. But figured I'd do an update. I've got about 20-30 minutes to do a video and get it uploaded now to you guys. So the update that I gave right here during the again underneath the previous post just mentioned at that point in time the QQQ was trading below the trend line. So just to summarize, and this all really goes back to yesterday, I highlighted these uptrend lines that you have. SPY or the S&P 500, both on SPY and ES, the futures had already taken it out. Let me show you that. But I said you need to see both the NASDAQ 100 futures and QQQ take it out. So this is what it looked like on SPY, took it out there. I also caught a question from yesterday that I did reply to. Somebody said, hey, Randy, is this a bull flag? Looks like a bull flag on SPY. Oh, absolutely. Yeah, it takes the form, volume. What you want to see are three things: an impulsive move up, that's called the flagpole. Then prices declining in a formation of a flag. And you want to see, ideally, you always want to confirm these with declining volume, which you have there. It's not, I will say it's not very pronounced, but typically you want to see lowered volume on the corrective move down when the flag forms. And then, as I said, if you want to take it for the reasons that I've covered, all these big divergences, QQQ breaking the trend line, everything else, it's not my thing. But you want to see an impulsive breakout, and that's what you have on above average volume. Actually, no, take that back. The big volume bar was at the close yesterday. So see, here's a good example. So in the reply, before we had broken out, I said, yeah, that's what you want to see. And you can see, you probably can't see it. I have my volume bars turned down. I don't like a busy screen. That was a very low volume candle there. In fact, it was the opening candle. And volume on any given day typically looks like a smile. There's a 5-minute chart of SPY. I'll turn my volume up so you can see the bars. And that's on, I think you can see them here. These are the daybreak lines. They're really real subtle I have here. But the volume almost any given day looks like a smile. It spikes in the morning. This is the open. Comes down and peaks or troughs about noon when traders are everybody's taking lunch, whether you're the guys on the floor or people at home, and then it spikes up again into the close. So where I'm going with that is going back to the chart I just showed you on the 60-minute. It was unusual. These are your closing volume bars there, and the volume was pretty low on that breakout above the flag. And so far, the other component you want to see after a bull flag breakout, if you're going to trade it, ideally the move coming out of the flag and the measured target should be roughly equal to the move preceding it. In fact, the measured target is the distance of the flagpole. That's what I did here. So what you do is you just go take a trend line, which I've done here, measure to the highest part of the flagpole, right where the flag started forming, and then that to the lowest part of the flag. And so if that were to play out, there would be your measured target all the way up here at about 567 on, and that would actually, let's see where my bounce target zone, my uppermost, 582. So that would take us a SPY almost there. Again, I doubt we're going to get there. I don't think it's going to play out. The volume wasn't that impressive on the breakout above the flag, and we've moved sideways since. So here, let me get away from that. I just want to mention that I did follow up to that question put to me yesterday. I didn't see it until this morning before I left. And so I'm still looking for a pullback here. So again, to reiterate, recap, breakdown yesterday in SPY, had ES also breaking down today. Here's a 60-minute chart. I'm going to pull it in tight. Before I do that, remember this is the trend line off the April lows. That is a near-term target. You also have levels right here. First target, 55.89, second, third, and that trend line. And then I'm going to pull it in tight for you right now so you can see this is what ES, the S&P 500 futures, looks like. So again, it had broken down yesterday. These are 60-minute candles. And as I said yesterday, the reason it's not going anywhere but sideways is because at the very same time, QQQ, which you have a different subset of traders, but they're trading the same stocks. QQQ, remember, is top heavy in the big market-leading tech stocks, which are the same top components of the S&P 500. So I've always said SPY is only going to go so far without QQQ following. And so this was yesterday. Again, I told you heading into the close, if we broke it, there was a chance to get a dump into the close. We didn't. We had an intraday break. There's your intraday. There's a good example of why you want to wait for a 60-minute close. If you look closely, the skinny part, i.e. shadow of this candle yesterday, pierced below the trend line, but then they rallied it up before the close to close right back above there. And then we popped at the open today, went down, tested it, had an intra-period break, meaning intra 60-minute candle. Then there's there's the 12 p.m. candle. That closed below it, and I just made a comment, added to that comment section, that this one was poised to close there, and now it has closed there. And this is the current candle right here. And it is 12:49 p.m. as I talk. So we've got 10 minutes to go, and that is about as good as it gets. You don't need to wait for it to finalize, because it would have to, in 10 minutes, we'd have to ramp up. It's doable. It would take, to just to back test the trend line would be a 0.5% move. To make a solid recovery back over it, we're going to have to go up about, almost 0.75%. So there it is. Take it, don't take it, that's up to you. Let me cover a few other charts and we'll move on here. So NASDAQ 100, this is the 15-minute chart. You can see the trend line break there. Nice little, you can see the divergence lines. Breakdown, back test. So, I always say when you go down in time frames, those are going to get you in quicker. If you're an NQ trader, then this is going to be your sell signal there. If you missed it or you only took a partial position, you could have added more on the back test, and so far rejection off the, again, that's a minor trend line. If you want to put the odds a little higher that breakdown is going to stick, then you go to a 60-minute chart, which this is. Let me zoom in here, take it in tight. Let's pull it in a little bit. 60-minute chart. You can see nice, well-defined uptrend line. Boom, boom. There's a breakdown, back test, and we're solidly below it on the futures as well. So that's it. Did the sell signals play out? I don't know. We've seen plenty of sell signals that haven't in the last couple months here. But what I said in that comment section or in the original post this morning, holds true. We are, and this is a daily chart. There's my targets. We're within today. So far, we came within 2%, about 2% right there of the market top range, which, like I said, that's where. As I said in the comment section today or in the post yesterday, let me tighten this line up a little bit. Let me fix it. There it is. That's the more significant. That's the April trend line again. That is a target for a quick pullback trade. And we'll probably step in. The buyers will step in most likely on a pullback to that level, and then we could get that thrust to the highs. So there's still, in my opinion, a decent chance that we're going to go on up another 2% or so from today's highs, or where we are about right now. That's about, call it 510, 511. I have it at 511.74. And at that point, I will treat the indirect hedges on their own technicals, their own merits. And really right now, that's only for me, unless I'm missing something, just crude oil. Just crude, because we had treasuries, as you recall, and this speaks to, I want to speak to the folks. See the same comments from the same group of people that it amazes me, as if I do these hour-long sometimes videos and say the same thing over and over, and these people either are not trading anything else on this site, treasury bonds, commodities. Natural gas, crude oil, precious metals. Let's just talk about the precious metals for a second. Back in, and this is going to speak to, people are saying, oh my gosh, I'm not making any money on the site. I can't understand it. These trades, right here was the last time I did an hour-long video, repeated follow-ups. literally bought the bottom, got bullish on the metals, and even clearly stated I preferred the precious metals. I'm sorry, the silver miner stocks and silver to gold. Highlighted my favorites such as WPM. We were long at the lows. Find a service that can time gold like this. Long there. Then we shorted here most recently on that divergent high. And, the silver miners, by the way, just the sector as a whole went up 60% off that divergent low. And just to illustrate, they outperformed the gold mining stocks. This is GDX, which went up 45%, which blew away gold. So, gold already had the case to go long the miners is because they hadn't gotten this memo. Hey, gold was up here. Miners at support. And it was the best buying op in many years. And then... and I remember the comments here. I set it up as a short, did a video right here at the end of May, and put them on as a short trade with targets that were identified on the 60-minute chart. So then you turned around, and made a 10 to 15% profit on the short trades. Hit those targets, and that was, I'm just picking the chart of SIL silver miners, and then once the final targets were hit, those were the objective long entries. And again, I use a lot of charts: gold, silver, GDX. This is it, off these divergent highs. So just in the last, what is this, month, and not even month and a half, this was a sell signal when gold and silver broke these trend lines. So I'm not going to pick the high, even though this is where I started putting them on as short setups. Got the sell signal there, swung it down. I made mention covering GDX, suggesting to cover that because gold and silver had hit their comparable price targets. And that was a 10% drop, turned around, went long, 10% pop. There's 20% right there, which blows away whatever the stock market has done over that period of time as a long. So this is swing trading, guys. This is how you make money. And then you also go long treasuries. Last update on long on treasuries was right here at that trend line, exactly at the lows. Ran up, hit the price target, get in, get out. It was a double weighted plus trade, meaning 2 times whatever treasury bonds did due to their low volatility. So that was about a 6% quick, we're talking just a few days. So guys, if you are only trading, and there must be folks that are doing that because I'm hearing about people not making money in this market, in my opinion, again, I would be having a shitty year if the only thing I was trading were the NASDAQ 100 right now. You got to spread it around. You've got to hedge it up. There's reasons that these trades are listed as both pure plays and or indirect hedges, and and even if you're bullish and going long QQQ, it's just investing and, in my opinion, swing trading 101. Don't put all your eggs in one basket. So, anywho, these trades, all but the equity shorts lately, the last few are firing on all cylinders, and plenty of those have hit targets, little shallow pullbacks and been covered throughout the year. So I did want to update. That's where we're at. Like I said, not a time, in my opinion, to be aggressively short, unhedged the equity markets. Again, if we get up to 510, 511, and I see a reason to remove any type of indirect hedges, that's where I will more than likely be aggressively short, unhedged. That doesn't mean I might not have other positions. Remember, wheat, corn, soybeans have been thrown out recently. They have nothing to do with the stock market. They're not a hedge. It is a way to diversify. You have an uncorrelated asset there. So, all right, that's it. I just wanted to mention, these sell signals will either pan out or not. That one, and so far we get these breakdowns and corrections, little pullbacks. This one, small pullback, and it got bought up. And, as we get tick closer and closer, we're already in that range that I have a high degree of confidence will most likely cap this whole run off the October 2022 lows. And we'll see. Time will tell. And if not, I'll tell you what, there's a lot of, when I go down the line, I've been talking about the abysmal market breadth, the underperformance of the equal weighted indexes. However, when I do, and I have been doing this, go down to the lower tier, the stocks that have not participated. There are a lot of stocks that are clearly in bear market. In fact, the majority are still below their key 250-day moving averages. A lot of those stocks are closer to 52-week lows than they are 52-week highs. Some of those are really starting to set up. So where I'm going with that is if we just blow on past this market top range and we just keep going, then and I'll pass along. I've covered a few of those in recent videos. I've got quite a few alerts set. I'm looking at some stocks. Those will, in my opinion, outperform the big tech stocks. In other words, Apple, Alphabet, Microsoft, NVDA, Meta, those stocks. I think you'll have more bang for your buck seeing that correction of that horrible breath. In other words, all those stocks that haven't participated will most likely outperform. So now on the flip side, and I don't have any of those queued up. I'll try to find some of the charts. Let me see here if I have. Let me just look at I'm going to go through some of the price alerts I had triggered recently. Some of those. That one, that's obviously a potential short. APO just broke down the trend line right there, but that's not what I want to get at. I'm just clicking on. Here's one, for example, and I highlighted this the other day, last week or so. I can't remember if it was before or after my vacation. But I highlighted this as a setup, and it's a semiconductor. And this one is coming off a 52-week low, if not an all-time low. I didn't go back that far, but you can see it's been in a clear bear market downtrend. And I highlighted this is one of the better looking ones, and it just broke out the other day. So I will highlight more and more of these. Now the problem is with those stocks is that in a bear market you're going to get these enticing looking setups with positive divergence, trend line breaks, they break out, and then they end up failing. That is the nature of a bear market. And this stock, say what you want about the stock market, this stock is clearly in a bear market. It's a semiconductor, and it's down 82% off its highs. That's run of the mill for semiconductor stocks. They tend to swing pretty big to the upside and then swing pretty big on the downside. So again, I will if we violate those top of those bounce target market top ranges on SPY and QQQ, I will start pumping a lot of these setups out, and I'll make a point to cover them in trade idea videos. Right now, I'm focused on that kind of core holdings or core trade ideas around the index shorts, because I see that one of the best opportunities in generational opportunity coming up on the indexes with everything that's gone on lately. Again, just looking at these targets, even if we just come back, and we will, that you have my promise on. I give very few guarantees in trading investing. You'll come back to the 200-day moving averages. Even the strongest and healthiest of bull markets, the indexes will, once they get too far ahead and it's been too long, they come back and they check their 200-day moving averages, like they did here, like they did when the bear trend. They come back to them under the downside. They backtest 200, backtest the 200, backtest the 200, took them back over. And so we haven't visited the 200-day moving averages since October, the end of October of last year. And so it's one thing tells us, history tells us, you're going to come back sooner than later and at least visit those. And so if you are longer term bullish, they align with, you can see right here, T1, depending on if and when that's hit, we go up a little more. T1, if the market goes up for a little bit longer, these 200 days are going to come in, and that would align with that first target there. It's also nice price support, and it's also it's a Fibonacci retracement level if we do hit the top of my market top range. What'll probably happen if we go down sooner, if this trend line breaks. Remember, I started the video showing you 15 and 60-minute charts. Here's the daily chart. It's the same trend line, for a near-term pullback target. But if that breaks, this is a weekly chart. So again, a weekly close, you want to see a red candle that on a Friday, at the end of the week, is clearly closed below that trend line. That's going to be a powerful sell signal. The odds will shoot up significantly, well over 50% chance that we're then going to, once that breaks, that we'll go down and hit at minimum this target and probably this second target, and what would probably look like if it happens anytime soon in the next couple months. it'll probably entail a punch down through T1. Well, T1, you'll get a reaction. I can, put a good odds. I think that's a very good chance. You have uptrend line and price support there, tradable bounce, turn around, game the bounce, cover shorts, go long, position back short again on the bounce back to resistance, wherever that is. We'll use the 60-minute and daily charts to figure that out at the time. And then the next punch down will be a break of that support level, which will probably take us down through the 200s because there'll probably be a lot of selling, and hit that 413-ish target, only to close the week back on or around the 200-day moving averages. And then, if this is some Super Bowl with a lot more life to go, that would be a great buying opportunity. I can't tell you if we're going to hit those 200s in the next month or 6 months from now, but somewhere in between there, based on history and how far away we are, based on the technicals right now, it's probably going to be closer to the former than the latter, meaning closer to that 1 month or so. Okay, so that's how QQQ looks from a long-term weekly chart. The S&P 500, it's the lower end of the range, has more upside, so they don't look like they're going to sync up. Again, that's why their range is also. It's about about 4.5% to the top of that range. And again, that was came up with those levels based on aligning Fibonacci projections. I have different boards I'm using. Some of them are so busy with all the fib projections and clusters and all that other stuff. So this is kind of what I call my clean board there. All right, so let's move on. I'll just address NVDA. Put out an objective short or re-entry yesterday right there at 129.83, and then was very quick to follow up in the comment section immediately below that post that I had tweaked the second price target from where it was previously, and also stating that keep in mind, unless QQQ clearly takes out the uptrend line off the April lows, odds are still decent. It can push up to the top of the market top range, which is only about 3%. So it's not much. Anyway, the important thing that if QQQ goes up, that's a net tailwind for NVIDIA. Net tailwind doesn't guarantee that if QQQ rallies, that NVIDIA must also rally, but it just increases the likelihood. It just has simply to do with order flows, computerized programs, which are buying the Qs, they're buying proportionally. And so let's just fast forward from yesterday to today. And that's what happened. QQQ had a little more upside because it closed, hit that trend line yesterday at the close, had one more bounce off it before it broke down today. And as such, logically, NVIDIA bounced along with it. But, ever so slightly off the 129.83 level. A total of, to the peak today, not even roughly a little less than 3%. And that compares to a target of the maximum target, 26%. So not even close to violating any reasonable stop. Usually reasonable stop at least a 2-to-1, if not a 3-to-1 RR ratio. Meaning, if you short it there, and you may not have been target, you may not have even taken the short. But if you did, if you're targeting that second target zone, that'd be a drop of anywhere from about 16 to 18%. So, you can use in that case, 9% stop, 8% stop, somewhere in there, if that was the case. And if you're targeting T3, you can use quite a bit more. And so you can see what happened. This is no surprise. There's NVIDIA went up because QQQ went up. QQQ gapped up, NVIDIA gapped up, QQQ reversed, then QQQ broke the trend line. And the million-dollar question, where do we go from here? Well, either this proves to be a little whipsaw. So far, that bull flag on SPY is not playing out as a bull flag should. It doesn't mean it can't play out. It just means when you break out, you pop above the flag, it's usually off to the races. Again, in a comparable, very impulsive, what I call unidirectional move, just like the flagpole leading up to it. And that hasn't been the case so far. So we'll see if it plays out. And we'll see if this breakdown proves to be a whipsaw. And if it doesn't, again, we've got some pretty significant levels just ahead. Let's move on to the, like I said, there's not many hedge trades. We had the Treasury bond hedge trade worked out perfectly. I told you my thing. I said, you can stay in there. There's probably more upside. I don't know. I just got out, took the quick, 6%, whatever it was, beta adjusted gain over a couple of days, got out, and I'll look to re-enter that if and when the charts tell me to, whether it's long or short. USO, told you I shorted it last week or so right here. So far, vastly outperforming, as I mentioned. The drop in USO is much greater than the rise in QQQ over that period of time. And then UNG, I don't really consider it an indirect hedge. It's a trade on its own. As I showed you, it tends to go opposite crude oil lately. So it's called a pairs trade, but it's also based on its own merit. And it's nothing big so far. But the longer term chart is still constructive on natural gas. And, so far it's up. And it's up, it's up more. And this is the point. So, QQQ right now is up 0.1%. Natural gas today is up 1%. So that's 10 times what QQQ is up. So if you are short QQQ and long UNG or nat gas futures like I am, you're making 10 times. Now, effectively less because you beta adjust it down. So even if you chop it in half, let's say you took a 50% or half position in natural gas, then you're still up, beta adjusted, 5 times what you are down on a QQQ short. And then USO down 0.25%, which is, over twice what the NASDAQ's up. So right now, like I said, I don't, nothing. I don't have anything in gold or silver, but we did, had, exited those trades with near impunity the other day. Silver hit T2 right there. Gold hit, like I said, gold. I mentioned take it out because of the reasons. Everything else hit resistance, including, silver at the downtrend line, which was the maximum target. And this is what I, trade as far as futures go. And so perfect exit, perfect entry. And again, this is just a swing trading. We shorted it down, swung it long, wash, rinse, repeat. Use stops, silver, if you're in it, I don't know if you're in it or not, but, bullish as I covered gold and silver yesterday. Bullish if that breaks out. I'm not feeling the charts right now of gold and silver. And if anything, I would probably lean towards the bearish case. As I mentioned before, gold just got to be, just like NVDA is the world's most crowded trade lately. Gold got to be really up there, really extreme with all that hype about Costco selling out of gold coins, everybody piling into gold. I mean, the breakout was legit, but I warned about it back here. It's just at best gold needs to probably work off, and it has been, working off those excessive bullish sentiment and overbought conditions. And it's been a dead money trade. So if you're a gold bug, you've gone nowhere for months, but up and down and exactly to where you started. If you're a swing trader like I am, then you've swung most or all of these, and you've made actually a lot of money. 20+%, especially on the metals and the miners or silver instead of gold, which tends to move up and down more. Other trade ideas, I'm just going offhand. I mentioned the home builders the other day. They're not soaring, but I told you, that was several videos back here laying these out as one of the better looking shorts. ITB or XHB, you can use either ETF or do the individual home builders. They dropped 16%. That was the target given at the time, and the 200-day moving averages. There's a good example too of a sector coming down and checking, buyers stepping in at the 200. They bought it there, the 200s, and there was a brief whipsaw, very bullish right there, because that's what we call a bear trap. There was a break of the 200s, short sellers piled in, boom, they ramped it up, recovered the 200s, and once the 200s were recovered, all those shorts got squeezed out, and the longs piled back in. But again, that came full circle with that divergent high. Yes, those things do work. And as I mentioned to you the other day in the video, we hit that 96, 93 target. Which was, I believe, the maximum one I laid out back here, at least an intermediate target, and out of 1, 2, 3, 200-day moving averages, positive divergence, and look, it's not up big, but it's up, it's up 0.8% today, which is 8 times QQQ, and so this is security selection, and it's still it was suggested if you want to take it, go long there with a stop somewhat below. Soybeans right back at the, it's the big support zone right here, long-term support zone, right where we bought it before, popped up. Remember, on the 60-minute chart, we hit T1 reverse. This is just a marginal new and still divergent low. And so, the outlook is the same. And wheat and corn, they tend to move together. Wheat still above the breakout of that 60-minute price channel. And, still looking good from a longer term perspective. These grains still look constructive. In my opinion, they're certainly in downtrends, but they're putting in these divergent lows. And again, of the three, I think soybeans stands out a little more than the others right now. And I guess that's it. Let me keep this video short. I've got to leave here again. I got to get this uploaded and out to you before I leave my desk, and then I'll be back. Hopefully, I should be back by the close. The VIX again looks like it's ready for the next big move up. This is a 60-minute chart. You get these divergent highs, divergent lows, simple stuff, right? And what you do is the VIX charts, they usually will mirror, but in reverse, the index chart. So what do we have on the indexes? We have negative divergences from the 15 all the way out to the daily, weekly, 60-minute, even the monthly charts. And you have trend lines that I showed you. Here's a trend line on the VIX. So this is, divergent low, long rally. And these are, the VIX explodes. So when you break support on the indexes, that's when they start to fall and then the VIX explodes. So just like, it's like trading GDX or silver instead of gold. They're going to move, VIX is going to move a lot more. Cuts both ways, obviously. But so simple stuff, right? Divergent high. After that divergent low, rally, drop, divergent low, rally, and then the rallies are significant. That was from the low to the high. I'm just measuring that point, even though I grabbed to the right of the screen. A 50% pop. Actually, no, I take that back. All the way before said and done off that divergent low, the VIX rallied 66%. Divergent low is pointed out at the time. We got one pop there. That was just that little last trend line break. One of the recent trend line breaks in QQQ did that. Now, what are you doing? Look at this. Look at all these lows. This is long-term support. I'm on a 60-minute chart, so this is where the VIX is about to let loose. In the stock market, if that happens, has a potential, like I've been saying, to poop the bed. And then when you look at the daily chart, same stuff, guys. This is, divergent low. These are big rallies. These are double and even quite often triple-digit rallies off these divergent lows. But most importantly is this support zone. I've been talking about it for months now. It's a long-term support zone. This is a daily. Here, you can see it on the weekly. Let me go to this board. You can see this is right here. This is what's the floor back here in 2019 and 2020. It was pretty much, it's been the floor for decades, the floor right here of the VIX, this zone. You can see we spiked to it there. That's the top of the zone. Other than that one period of extreme, these were record low, never before seen drops in volatility that occurred there. But when you go back for decades, this was right about here. For the majority of time was the low, the trough, the low point in the VIX. So here's the takeaway, and I'll end the video with this. And I know you've got just this, consistent group of hecklers. You guys do what you want. I wish you the best. I wish you would diversify for your own sake if you're, getting clocked on this market. But I can tell you this right now: the VIX is on sale. Volatility is at extreme end of its low range. Puts are cheap. This is when options traders can make a lot of money, and that's not my big thing. You can use pairs trades to kind of mitigate your losses, but typically you want to be a buyer of puts when the VIX is down here, or buyer of options, if you will, buyer of puts, and you want to be a seller of options, seller of puts, or you want to be selling options up here, buying them down here, because when the VIX is high, the premiums are high. Now, if you don't know what you're doing, stay away from options. There's no faster path to ruin, in my opinion, than trading options. Trade shares, stick with shares. Don't use leverage until you've cut your teeth on trading and you're showing a fairly consistent, profitable trend. But I just want to point out long-term support here, as I have been pointing out for weeks now, in these series of divergent lows. This last divergent low back here, that was good for about 174% rally. This one back here, That was obviously COVID and all that, but the VIX blew up 600 and something percent. And right now, all I can tell you definitively, as I've been talking about, we've been making these series of divergent lows. And again, it's not as if they haven't played out. That first divergent low was good for roughly, we had an roughly equal low there. I'm going to measure it there. That was about a 84% rally. This one here, also mentioned at the time, that was good for about an 84% rally as well. And the only thing that's changed is this divergence. All these little divergent lows, which were there each, in themselves, new divergent lows, but they're an extension of the existing divergences that have been building. No different than the negative divergences that have been building on the stock indices. And so there are no hard guarantees with this stuff, but generally speaking, and much, much more often than not, these things do play out. And generally speaking, again, no guarantees. The bigger the divergence, the bigger the ensuing move once it happens. And I've seen all kinds of, I don't talk about all the fundamental stuff I read, but one of the many things, Bank of America, I think it was, just said the commitment of traders, COT, is unusually long right now, very heavy long positions chasing this market. And they talked about where their stops usually are, and it's only like, I think they said about a 3% or so drop in QQQ should start firing off all those stop loss orders, and then they reverse it and they go the other way. And that's where you get those very sudden, out of nowhere kind of drops in the market. So all I'm saying is ingredients are there right now for it. Do we push up a little higher? Like I said, maybe 2% I see most from where we're at right now in QQQ is the most likely scenario before that happens. But we're already in that target zone. And again, just where I start the video, I'll leave off. We're already, on that, at least on the 60-minute time frame, we've got clear. So NQ, the NASDAQ futures, as I showed you, ES, the S&P futures, SPY, and now, finally, as of today, QQQ below that trend line, which I said yesterday in that video was either going to break down most likely yesterday in the final hour of trading, which it didn't. You got a little stick save there, and it held printed above there, printed a nice green close back above it. But there's your sell signal today. So I don't, minor support here. This is where you'll see, this is where we've had consolidation. So a lot of the stops are probably parked right here. It would be a great bear trap too, to punch down through there. If the powers that be have enough muscle right now to move the market down, clear those, blow out those stops, and then run it up to the top of the zone, it's certainly possible. However, if they don't, the buyers don't step in, either on a pullback to that 495.50-ish level or on a little whipsaw down through it, this is where we're going, most likely. And that would be from the breakdown point today. If you took it, nothing much, but a 2.25% drop, and then watch, rinse, repeat. Go on, make your 2.25% on NQ. If you trade NQs, I don't have to tell you how much that puts in your pocket per contract. Game of bounce, if the charts tell you, 5-minute, 15-minute, even 60-minute charts, or hold out for the prize, which right now the near-term prize is at 60-minute primary uptrend line off the April lows, and that's going to come in, again, depending if and when we hit it, that's going to be about a 4% drop to that level. But that's also a big, 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 big level that I'm watching for, waiting for, and expecting to give way on the longer-term, more significant weekly charts right here. Zoom in, I'm sorry to make you dizzy there. This trend line right here. That's the same one off the April lows. And when that goes, and based on everything I just said about the VIX just poised to pop, and an extreme bullish sentiment and one-sided, top-heavy trade, that's where those are the times you get those pretty swift moves down. CNBC comes on, they don't know what happened, they're trying to explain where the big move came from, and that's all it is, guys. It's just technicals and, again, the underlying dynamics of the market, meaning, shorts have given up, so there's no shorts to cover on the way down, and stops start to get hit on the longs, and blah, 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 blah. All right, guys, those are the levels. Trade it as you want. I will continue to hunt for trade ideas, but this is kind of my focus on, the things that I've been talking about lately. Just like I said, right now, it's just a few things, really. The equity markets, and crude oil and natural gas, and, a little bit in the soybean. I'm not too hot on soybeans at the moment. I mentioned to somebody, it looks good. I think the charts are so constructive. I can make a case to buy, still be into those. But I would, at this point in time, maybe a half position waiting for the charts or a partial position waiting for the charts to firm up a little bit more, meaning we start to go and take out some of the nearby resistance levels and confirm the divergences that you see here. Here's a 60-minute chart. So there's that divergent low. And what you don't want to see is, it continue to drop, and then all of a sudden the indicators drop and you no longer have positive AK bullish divergence. You're no longer at support. So we already hit T1 once. We need to now run up there and now break T1, and that should. If that happens, and it happens soon, then I think the chances are real good we'll go on to hit these next targets. Okay, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart, and I will follow up later today after I get back from my next appointment.